Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Scott Nations, President of Nations Indexes, to discuss why option volatility shows there is relatively little fear in this market. Scott, it's great to see you as always. Welcome back to Trade Talks. And I want to talk about two things here. First, breadth and what you're seeing in terms of the volatility markets.
Yeah, Jill, we talked about breadth before. It's not been very good this year, and it's just gotten worse. So if we look at the S&P that everybody's familiar with, cap weighted, it's up just over 16% year to date. Now that's price only, but it's up just over 16% year to date. But if you look at the equal weight S&P, so everything gets the same weight, it's not cap weighted, that is up 4.2% so far this year. So the cap weighted is up nearly 4 times what the equal weight is. What does that tell us? Well, it tells us that breadth is horrible and that a few, and I mean less than 10 names, are responsible for most of the S&P rally this year.
Yeah, and even with all that said, we're seeing, in the option volatility space, doesn't look as if there's much fear here.
No, it's really unusual given where we are in the calendar and the fact that we have a big Fed meeting in the middle of the week. The volley is below 12, the VIX is below 14, and Taildex, which measures the cost of crash protection, is below 11. You don't have to be very old to know that September and October are often pretty tough months for the market, and there's lots to be worried about. China is so opaque, and the Chinese property situation is so opaque to us. And UAW is on strike at 3 different automakers, and I can see both sides in that case being supremely intransigent. And if that's the case, then there's no telling how long that's going to go on.
Yeah, and I'm surprised that there's not much pressure, or when you look forward, thinking about how this is all going to impact the consumer. The longer this goes on, depending on what the result is, like we saw with UPS, shipping's getting more expensive. We know inflation is still an issue. We know student loans are coming back online. Autos are going to get more expensive depending on how this all plays out. And I just think there's a lot of reasons for people to be worried about the consumer being squeezed as well.
Yeah, I think inflation remains the biggest problem that we have. And that our market has, because we know the Fed's going to have to react if it takes another jump upward. And to your point, let's look at the UAW talks. No, I don't care what your political point of view is or what your point of view is about organized labor. They are going to get a big pay increase this time. It's baked in the cards. It's just a function of the way that cycle has worked. And all of the automakers are going to have to pass that along to buyers in the form of inflation. And so, yeah, if you're in the market for a car, you're going to have to pay up.
Let's talk about China again for a moment here. It seems as if they're decoupling from the globalization theme that they've worked for years to try and get themselves. We know what China's done for global trade and so forth. Do you think with them continuing, it feels like they're just decoupling from the rest of the world? How can that impact global trade or what that means for consumers?
Yeah, I think you're absolutely right. I think investors who are focused on international stocks are going to have to be very careful. Again, China's incredibly opaque to the average American investor, even smart institutional investors. We really don't know what's going on with their housing market or their real estate market. And they don't seem inclined to help us at all, to give any insight. And so in a case like that, where there's this goofy, extraneous risk, I think investors have to be very, very careful, and they really have to demand a bigger margin of safety. They do that by paying less for Chinese stocks.
Yeah, well, I guess at the end of the day, picking up protection as cheap it is right now with volatility being depressed is probably one of the better strategies.
Yeah, I'm not suggesting that because there's not enough risk that long-term investors should be selling stocks. If you sold your stocks every time you got worried or every time there was not enough risk or risk appropriate to the market, then you would never own stocks. So I'm not saying that. I'm simply saying that steel yourself. If we have some volatility here in our market, again, because of the UAW or inflation, we get a bunch of inflation data next week, or something going on in China or something going on in Ukraine, just steel yourself for some volatility and realize you had it coming, and look to pick up some stocks at a discount.
All right, Scott, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.